Hello everyone, I am Robin. The voiceover is an AI voice, it's not my real voice. I have used it to ensure clarity of the message I wish to communicate to you all. Welcome to my channel. Thank you if you have already subscribed to my channel. If you are new to my channel, I have a humble request to make you. Kindly support me by subscribing to my channel. With your support I will be more motivated to come with better content in near future. Without wasting much of our time, let's get to the point. First of all, let's understand. What is mutual fund? Going forward we will discuss its pros and cons. I know most of you must already know about it, but please find what I have to offer you. Thank you and please stay connected. A mutual fund is an investment vehicle that pools money from multiple investors to invest in a diversified portfolio of securities, such as stocks, bonds, or other assets. It is managed by professional fund managers or investment firms who make investment decisions on behalf of the investors. When you invest in a mutual fund, you are essentially buying shares or units of the fund. The value of these shares is determined by the net asset value, NAV, of the mutual fund, which is calculated by dividing the total value of the fund's assets by the number of shares outstanding. Mutual funds offer individuals the opportunity to invest in a professionally managed portfolio, even with a relatively small amount of money. By pooling resources with other investors, you can gain access to a diversified range of investments that may not be feasible to achieve individually. The main types of mutual funds include equity funds, investing in stocks, bond funds, investing in fixed income securities, money market funds, investing in short-term, low-risk instruments, and balanced funds, investing in a mix of stocks and bonds. Investing in mutual funds allows you to benefit from professional expertise in selecting and managing investments. The fund managers conduct research, analyze market trends, and make investment decisions based on their assessment of potential risks and returns. They aim to generate capital appreciation or income for the investors, depending on the fund's objective. It's important to note that mutual funds charge fees and expenses for their services, which can include management fees, administrative costs, and sales loads, commissions. These fees vary among funds and can impact your overall returns. It's essential to understand the fee structure before investing in a mutual fund. Mutual funds provide liquidity, allowing investors to buy or sell their shares on any business day at the current NAV. This flexibility provides easy access to your investment, unlike certain other investments that may have restrictions or penalties for early withdrawals. Overall, mutual funds offer individuals a convenient and accessible way to invest in a diversified portfolio managed by professionals. They provide opportunities for potential returns, but it's important to consider factors like fees, investment objectives, and risk tolerance before investing in a specific mutual fund. Mutual funds are investment vehicles that pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other securities. They are managed by professional fund managers who make investment decisions on behalf of the investors. Mutual funds offer several advantages and disadvantages, which we will explore below. Let's understand pros of mutual funds. 1. Diversification. Mutual funds allow you to invest in a variety of securities, such as stocks, bonds, and even commodities. By spreading your investments across different asset classes and industries, mutual funds help reduce the risk associated with investing in a single security. Diversification helps protect your investment from the potential impact of a single company's performance or market volatility. 2. Professional management. Mutual funds are managed by experienced professionals who conduct in-depth research and analysis to make investment decisions. These fund managers have access to extensive resources and expertise, which may not be available to individual investors. Their goal is to maximize returns and manage risk by selecting suitable securities for the fund's portfolio. 3. Accessibility and affordability. Mutual funds are easily accessible to individual investors with relatively small amounts of money. You can invest in mutual funds with as little as a few $100s. This makes it possible for people with limited investment capital to participate in the stock market and benefit from professional management. 4. Liquidity. Mutual funds are generally highly liquid, meaning you can buy or sell your fund shares on any business day at the current net asset value, NAV. This provides flexibility and allows you to access your investment when needed, unlike certain other investments that may have restrictions or penalties for early withdrawals. 5. Transparency. Mutual funds are required to disclose their holdings, performance, and fees on a regular basis. This transparency enables investors to make informed decisions based on accurate and up-to-date information. You can track the performance of your mutual fund investments and understand the assets in which your money is invested. Now let's dive to understand cons of mutual funds. 1. Fees and expenses. Mutual funds charge various fees and expenses, such as management fees, administrative costs, and sales loads, commissions. These fees can eat into your returns over time. It's essential to understand the fee structure before investing in a mutual fund and consider low-cost options like index funds or exchange-traded funds, ETFs. 2. Lack of control. When you invest in a mutual fund, you entrust the decision-making to the fund manager. This means you have limited control over the individual securities chosen for the portfolio. While professional management can be an advantage, some investors may prefer more control over their investment choices. 3. Capital gains taxes. Mutual funds distribute capital gains to their investors when the fund sells securities at a profit. Even if you didn't sell any of your mutual fund shares, you may still be liable for capital gains taxes. This tax liability can reduce your overall returns. Consider tax-efficient funds or tax-advantaged accounts like IRAs if you want to minimize the impact of taxes. 4. Market risk. Like any investment, mutual funds are subject to market risk. If the overall market or specific sectors perform poorly, the value of your mutual fund investment may decline. However, diversification within the mutual fund can help mitigate some of the market risk. Conclusion: mutual funds offer several benefits for investors, including diversification, professional management, accessibility, liquidity, and transparency. However, it's essential to consider the fees and expenses associated with mutual funds, the potential lack of control over investment choices, the impact of capital gains taxes, and the inherent market risk. By understanding these pros and cons, you can make informed investment decisions and choose the mutual funds that align with your financial goals and risk tolerance. It's always advisable to consult with a financial advisor to determine the most suitable investment strategy for your individual circumstances.